Good morning, everybody. We're going to wait a few seconds here while everybody's joining, and we'll get started in about 1 minute. Thank you again for taking time out of your busy schedules to join us for our proprietary educational series, WP90X. And it's my pleasure to introduce my two partners that are the partners in charge of our private placement life insurance and variable annuity practice, Ben Rainey and Aidan Elliott. For us, most importantly, this has been a venture that we have not gone into lightly, as we don't do anything. We found that private placement life insurance has always been suspected to be of benefit to ultra affluent clients. The problem is the education, both at the advisor level and the client level, has been lacking. It's been a bit of a black box and seemingly way too complex, and also inflexible. And so when we made the decision to go headfirst into this and to do it in a way that we felt the market was lacking, we wanted to do it so we could do two things, really, to accomplish the goal of allowing the advisor, the wealth management advisor, or the tax advisor, the ability to truly see all of the different moving pieces and parts and be able to model and use financial modeling to adjust the assumptions and see where it breaks, because there is no free lunch and there's always a point where something doesn't work, but it's a pretty low bar in terms of this particular product. And then more importantly, for the client to be able to truly see and understand what's the problem that they're looking to mitigate or solve, and how are they going to go about that. So without further ado, I'd like to turn it over to Ben and Aidan. In terms of questions, if you have questions, we have Michael Kenneth also monitoring the questions, but please use the Q&A function on the bottom of your toolbar in the Zoom meeting, and we will interrupt at the appropriate time to get these guys to answer those questions. So thank you for attending, and Ben and Aidan, you guys are on.
Ryan, thanks so much for that intro. I think it's only appropriate that there's this glorious halo coming in from behind us.
It's actually over my head.
For the most anticipated CE event of the new year.
Of the year. We're only 2 weeks in, but we know we've all been looking forward to it.
I mean, when you guys were in middle school and high school, did you ever think you'd be listening to such a captivating presentation on mitigating income tax drag with private placement life insurance and annuities? So we know that this could, at least in theory, be a very dry and boring conversation around tax and life insurance. We're going to do our best to make it anything but that. We put a lot of work into this presentation. We hope you all benefit. We're going to take a look over the next 90 minutes or so, again, about what private placement is. I know a lot of you on the call probably have heard of it in some form or fashion. You might even have dealt with it. But we're going to kind of, we have something for everyone. And so we're hopeful that this time will be well spent for everybody. Again, as Ryan said, please interrupt us with questions in the chat. We would absolutely love to answer those along the way, and we'll get started.
Yeah. Okay, so everybody, just a couple of learning objectives, because this is a continuing education event. So firstly, they'd like you to understand the basics of private placement life insurance and variable annuities and how they work. Identify the types of investments that can be utilized inside the accounts and how they're priced. Define the tax treatment of each strategy. Address common misconceptions about the investment and the recent evolution from insurance dedicated funds to separately managed accounts. And then finally, identify 3 client situations. We have a couple of case studies that'll kind of bring home the education, and just that they work from a goal-based planning approach. Each of them is different. You want me to start on this one?
I mean, we told them we wasn't going to be dry and boring, so
Well,
here we are.
I guess
Sesame Street makes the appearance early on in the show.
yeah, kind of to what Ryan said at the start, everybody. This is kind of funnily how I viewed it at the start. Like Ben agreed. We see PPLI and PPVA kind of as the snuffleupagus of the life insurance industry, the imaginary friend per se. I think the majority of you on the call, you're here for a reason. You've probably sat through continuing education events. You've read about it yourselves. Maybe you've seen a client that has it, but you've maybe not done it yourself. And there's reasons for that. We'll get into that throughout the conversation, but kind of just to start us off, it's kind of everybody's here for a reason, but nobody's really maybe done it before.
So we're here to hopefully take this thing from this imaginary concept, to actually helping you see one in the wild, so to speak. And so we'll move on from Sesame Street and Big Bird. Yeah. So let's start with the basics. I know as I said earlier, a number of you, this is going to be kind of old hat. You know what PPLI is, or maybe even you think you know what it is. So hopefully the way we talk about it might even clear up a few misconceptions. So at the risk of kind of covering ground that you may already know, let's cover again just the real basics as to what is PPLI and what is PPVA and how does it work. And then we're going to talk about some of the reasons why it's not worked as well as maybe it should have in the past.
Before we get into that, guys, I'll just give you a brief 30-second history, not to bore everybody here, but just to go into it. It was originally developed, the two strategies, as a cost mitigation structure in the life insurance industry. One rogue CFO in the late 70s. Oftentimes, life insurance is used in a corporate setting to fund corporately owned or non-qualified. It's called corporately owned life insurance. Rogue CFO basically said, I don't need a charge to earnings on my balance sheet in year one by, getting this really important tool for my executives and my chief staff. I don't want to have this I'm going to deposit after-tax dollars into an account and then I'm going to have a negative hit. So originally the life insurance industry designed these chassis or policies to amortize the costs that an agent gets and the structure, the cost of the policy over the life of the policy. Instead of having these surrender charges over the first 10 years or 20 years, that was all done and spread over the policy. So it started just as cost savings, really straightforward. And then from there, the industry developed. It got use in the ultra high net worth individual market space, a lot of times with asset protection planning in mind. So using the life insurance structure to move money offshore. Further then in the late 2000s, when the hedge fund was the investment vehicle du jour, there was these insurance dedicated funds created. And now it's morphed to today when pretty much the separately managed account has allowed clients to invest in anything they do taxably inside the medium of a life insurance policy. It's a really quick history, but it's a good starter.
Thank you, Professor Aidan.
I must be wearing like a tweed jacket for that as well.
Exactly. So think of PPLI with that history and context as PPLI and PPVA as specific accounts that protect investments from taxation. And when we say taxation now, we're talking about income taxation. So as Aidan said, they're institutionally priced products. So they're life insurance and annuity products. That second bullet here, it's designed for investment performance, not death benefit. And this is a big and a big key point for most people. When we typically think about life insurance, most designs, especially in as Ryan mentioned, WealthPoint has long been known for our ability to structure and design very large life insurance transactions for wealthy families and individuals. And when we do that for the estate planning world, we typically minimize the outlay, right? And get as much death benefit as possible to increase the IRR at death. Private placement life insurance takes that equation and completely turns it over. And what we do with private placement life insurance is we stuff as much money into the product as possible because we're using the product for the investment or for the tax wrapper, not for the death benefit. And this is a really key point. This is the sub bullet here again, lowest possible death benefit, highest funding amount. We'll show you how that works in practice. But this is also where it breaks. If you don't get this right, this also can create problems for PPLI down the road. So again, this is key to understanding PPLI and why it works. And functionally why a well-designed PPLI product will work very, very long term. There are no surrender charges on this product, as Aidan mentioned, because it's priced for high net worth families and individuals. There's no surrender charges. So there's a very low cost of entry. Someone wants to get in and they want to get out. They're not going to get hit with a big surrender charge. And then finally, fully disclosed transparent pricing. One of the things we do at WealthPoint is disclose all compensation on any product. But with PPLI, regardless of who you choose, all fees, expenses, everything are fully disclosed anyway. And we'll show you exactly how we disclose that as well later on in the presentation.
Tax benefits of PPVA, so variable annuities, it's characterized just as a normal annuity, everybody. So I think everybody on the call probably has a knowledge on how these work. Essentially, I put after-tax money into an annuity and I can defer growth, and then anything comes out on a LIFO basis. So if I need to make a withdrawal from an annuity, gains come out first, they're taxed as ordinary income. And then after I've depleted my gains, I can get my basis back out tax-free. Some nuance to PPVA in a group variable annuity setting. It's used oftentimes in the nonprofit endowment sector. If I have a nonprofit and endowment, certain assets on my in my investment account, they're taxed with unrelated business taxable income. If I put those same investments inside a private placement variable annuity, I recharacterize the income as annuity income, and that's no longer taxed to me. So it's an extremely useful vehicle in that space, and it's used oftentimes there.
So tax benefits of private placement life insurance. You guys may know this. PPLI looks just like any other life insurance policy. So you get that tax deferred growth of the account value. You get tax-free access to the cash value, the account value in there. So any of that growth can be pulled out via withdrawals to basis. And then after you've withdrawn your basis, you can get the rest of the, or most of the rest of the gain inside the policy via a policy loan. And then ultimately, as you guys all on the call probably all know, all life insurance contains a tax-free death benefit. And subject to the second bullet, or this last bullet here, is what's beautiful about private placement, the private placement space for life insurance and variable annuities is they're embedded in all the relevant code sections. So it's not like there's a specific code section that governs PPLI, PPVA. In the eyes of the IRS, PPLI is just a VUL, a variable universal life contract. It doesn't look, feel, or act any different. The fact that we're stuffing 5, 10, 50, $100 million into these contracts, in the eyes of the code section, it's just a life insurance policy. So it's afforded all the same things. And again, I think that also gives us very significant standing when it comes to potential regulatory threats. You know, will this be challenged in terms of, you know, will they try to tax the inside buildup of cash value, things like that down the road? We think it would be a very difficult task for them to do, just simply because of how prevalent it is in the tax code already.
So problems with PPLI and PPVA until now, everybody. So why is it that they're the snuffleupagus of the industry, that they've been less used? Well, we feel with a firm understanding.
Sure, can see you.
Absolutely. So with a firm understanding of both chassis, and if we all delve headfirst into this like we have, we feel that there's no reason, if you have a bias towards advancing your client's balance sheet, that these wouldn't be leveraged. But there has been problems and inefficiencies in the marketplace itself that have kind of gotten in the way for us to all apply our understanding and utilize them, again, when we're providing advice to clients. So the first one, again, the investment manager was never in control, essentially. So when I said in the late 2000s, the hedge fund was the investment vehicle du jour, what used to happen is I could invest kind of similar, like a variable universal life policy, where there's mutual funds offered on state registered mutual funds that are offered on a menu basis at the life insurance carrier level. And then I could select investments if I'm the client or I'm the insurance advisor of what my client would invest in. It was very similar in the PPLI and PPVA space. There were specific funds created that could only accept insurance dollars, but from marquee names in the investment management business. Think private credit managers, private equity managers, hedge fund managers, hedge fund of fund managers. But they were specific, again, to the insurance level. So if I'm the client or if I'm the investment manager, I can't necessarily control the account itself. It's not bespoke to me. The next was underperformance of those insurance dedicated funds. So oftentimes the funds that were offered on the menu basis inside the life insurance policies weren't as good as the funds that I could buy in my brokerage account. What led to that then is there's a further lack of transparency in the old approach to PPLI and PPVA. A lot of stuff going on in regards to costs. It wasn't open architecture in regards to, I know what I'm paying for my funds. I know what I'm paying the insurance broker. I know where all the money is flowing at any one time. Oftentimes, again, that can get in the way either of the advisor kind of recommending it. If I can't see what's going on, I'm not going to recommend it, but also the client. If I don't know what I'm paying for, what am I going to do? Why would I do this? Expensive funds. So oftentimes these were more expensive because they were offered inside a tax-free location or tax-deferred location in an annuity. The fund managers will put an extra charge on there. So 2 and 20 funds became 3 and 30 funds sometimes. So that got in the way. Client and advisor confusion, right? I think we can all admit to this, right?
Well, this is something we talk about a lot in the new model is when you confuse, you lose. And so from an advisory perspective, if I'm the investment advisor on the account and I say, hey, I've got this great vehicle, I can block all this tax, and you might be able to explain underperformance and lack of transparency in the expense of the funds, but now you've got to re-explain a whole new asset allocation model to your client. And candidly, it's just not worth the effort in a lot of cases to try to explain this new fund, and you got to go pull the PPM and you got to read it, you got to understand it, and then you got to kind of trust that they're going to do what they're going to do. So I think the old model just had a lot of kind of roadblocks along the way. It's still been very successful. I mean, the largest Ppli provider, Lombard International, they're out of Philadelphia. They've got about $60+ billion inside of private placement wrappers at this point. So it's not been terribly unsuccessful, but there's just unnecessary hurdles, we think, in the way at this point.
Yep. Last two. So next one, lack of leadership from the life insurance industry. We kind of took a good look at ourselves, and we think this is a big reason for it as well. There's very few players in the private placement life insurance and private placement variable annuity space that do it well. And this is life insurance and annuities on purpose, for the purpose of mitigating tax on a portfolio. Therefore, it's incumbent, or was incumbent, upon our like agents in the life insurance industry, companies in the life insurance industry, to educate wealth advisors who can now manage the assets on a bespoke basis, get paid to do so, and not only do that, but again, advance their client's balance sheet by doing so. And it was just kind of, it was off kilter. Reason being was, I guess I get paid more on a traditional life insurance case than I do on a private placement life insurance case or a private placement variable annuity. We get paid more to place term policies than we do life insurance policies in the private placement world. So maybe that's a reason for it too. I think oftentimes maybe life insurance agents might have been scared because these are esoteric investments that underlie oftentimes these accounts. So hedge funds and private credit, private equity, and that scares oftentimes life insurance agents that maybe aren't as trained or well-versed as the investment management industry in that sort of recommendation. And then the last point, generic and static modeling and illustrations. You know, it's a life insurance product, it's a life insurance industry. Oftentimes what you see, you know, from a marketing perspective or from an analysis perspective from our world, unfortunately, is a static rate of return. We'll pick 7% and we're going to get that for the remainder of the life insurance policy. And we're going to wag and pick this tax rate return at 40% or 45%. And everything looks fantastic. It looks really good. But the only thing really that a life insurance illustration can prove is that paper can hold ink. And I think that oftentimes can get in the way of clients making decisions, but also advisors trusting the deliverable that the life insurance industry is putting out when they're educating their clients on the two asset classes.
So with all that said, and with all that in mind, how in the world, you know, one, I mean, I don't know how I would say Lombard got 60 billion. I mean, it's a great product. So what's changed? What's the big aha now? And why should, you know, you guys are on this call, why should we even be paying attention? There's all these problems with it. What in the world's going on now that should be any different? And so the solution, or kind of the new innovation in private placement life insurance and private placement variable annuities, and actually it's not even that new, it's been around a long time. There's kind of been a resurgence, right? Things kind of ebb and flow, and I think this is kind of the ebb and flow of private placement. Again, hedge funds were the vehicle, the investment vehicle du jour, as Aidan likes to say, but now money's managed very differently, right? And so the SMA, the separately managed account, is the aha. And really what that is a custom portfolio structured for individual clients that's managed by their RIA, their investment manager, whatever. And the beautiful thing about this is anything that the advisor is doing for the client taxably can be done for them inside of these Ppli and Ppva accounts. Mm-hmm. And that's the aha. And honestly, it seems really simple. Like, wait a second, there's got to be more to it than that. There really isn't. So for the our investment advisor friends on the call, anything you guys do for your clients in a taxable world can be relocated to a Ppli or Ppva account, and you can do it there. So you see the list there on the screen of potential asset classes. everything simple, stocks, bonds, ETFs. I mean, you can do individual stocks. If you want to load up on Tesla for some reason, you can absolutely do that. But you can also do hedge funds. You can do private equity, venture cap, private credit. You can do, again, real assets. One of our favorite things to tell people that's actually owned inside of a private placement life insurance contract is 1/3 of the Santa Monica Pier in Southern California is owned inside of a PPLI insurance contract. So if you want to get really goofy and really crazy, you can absolutely do that. And so that's kind of the aha. So what's that do? That eliminates all those problems that we previously discussed about prior iterations of PPLI. There's no investor confusion. Hey, Mr. Client, what I'm doing for you taxably, I can now do for you tax-free. Transparency on fees, expenses, we already talked about that. That, again, that now enters the picture again. Underperformance, there's none of that. You guys manage the money exactly like you've been instructed to do from the client. Again, all those kind of negative things now get eliminated through the SMA platform.
Yeah, and we're all advisors on this call in some way, shape, or form in different sizes. And think how important that is, though, to kind of mention what Ben says. We all have psychological biases in our heads, and clients, one that they suffer from significantly is status quo bias. So if we can get rid of that extra layer of complexity, it's a lot easier to say your current portfolio can be owned just in a new place. It's a new location. We're not changing anything like that. Again, that big problem before was I have a great portfolio that I like, or it's fine. I'm just going to put up with it going forward. I educate the client on the benefits of life insurance and annuities from a tax perspective, but now I have to recommend a different investment type. So I have to educate them really on the tax benefits, and then I have to have another complexity conversation on how we have to rearrange their entire investment portfolio. Now we don't have to have that. Now we just need to educate the client on the tax benefits of life insurance and annuities, and the investment portfolio stays the same. It's a huge change.
Yeah. So I'm going to pause here just for a second. We haven't had any questions come in, but oftentimes on this slide or kind of at this point in the conversation, we have clients or advisors start go, wait a second, you're telling me I can own X, or is it really this simple or whatever? Again, for the investment professionals on the call, we use your current custodian. From a dashboarding perspective, the stuff that you see for your client, you're going to see like a brokerage account, an IRA, and then you're going to see a PPLI account. The titling will be a little different, but again, you'll see it. The client will be able to see it, things like that. So if you guys have any questions on this, please just drop them in the chat. We're happy to answer them as we keep going. So let's talk about the ownership of private placement contracts. And it's really simple. Again, I know life insurance one can be a little complex to begin with. It can feel very weighty, or what the right word is there. But basically, private placement. Again, we say the word account a lot. We want you guys to kind of think of it that way, to try to simplify it in your mind. It's really just another account. Yeah, it's a layer of insurance on top of that, but functionally, it can integrate in any of the client's planning that they've already done or planning that they will do. So very simply, we can own it outside the estate, or we can own it inside the estate, right? And certainly any kind of trust planning you may have done, any kind of dynastic trust planning, CLATs, GRATs, SLATs, anything like that can absolutely be integrated into the planning of the PPLI. So we got a question in. This is awesome. Love that.
From anonymous attendee at 9:24 a.m. Can you hold all the same types of investments in both PPLI and PPVA? Are there limits on return?
So the answer is yes, you can hold both in both contracts, or both account types. You can absolutely own the same types of investments. You're going to have a slightly higher limitation on illiquid or alternative strategies inside of private placement life insurance, simply because there's a life insurance benefit that has to be paid out, and the carrier is going to limit you to 60 to 70% of your account value into alternative strategies. They don't want you to go 100% into VC, so to speak. All those investments go to zero, and then they're on the hook for the death benefit, right? So let's just say, as a general rule of thumb, 2/3 can be into alts in a PPLI contract, and the third needs to be in T2 money. So stocks, bonds, ETFs, things like that. In a PPVA contract, you can be more aggressive on the alts, simply because there's no death benefit that needs to be paid out. So you would typically see higher limits in the PPVA world for alternative strategies.
Another question.
And there's no limits on return, by the way. So if you put in assets, if you invest inside of assets inside the PPLI account, that you get 15, 20, 30%, no problem. In fact, that's the optimal scenario, right? High yield, high tax assets are the optimal assets to own inside of these contracts.
Guys, there's another question in the chat. How are investments transferred over, i.e. who handles the documents for existing or new investments? Who makes the investment decisions, i.e. buy, sell, or hold?
Yeah, so there's no, so I think what Robert's trying to say is, how are the investments transferred over? So Robert, just to clarify, this has to be cash invested into the life insurance and annuity policies. So if I have an investment portfolio, we need to do a tax analysis, and then we need to divest out of the strategy, liquidate the cash, and then put the cash into the policy and then reinvest in the portfolio. So that's how that works. Who handles the existing documents? That would be the investment manager. So again, it's just like, again, any liquidation or any move from any account, any brokerage account, I'm going to go to cash, and then I'm going to just invest inside my new account. In regards to the life insurance, that's handled by WealthPoint. We would need to underwrite the client and get an insurance policy in place. Same thing with the annuity, but minus the underwriting. There's no underwriting with the annuity. We would just get the annuity set up. That's WealthPoint's responsibility.
But to be clear, the current investment manager can remain the current investment manager in almost all cases.
Correct. And then Robert, that last point, who makes the investment decisions? It has to be the investment manager. So the client cannot direct any investment decisions whatsoever in these policies. It's a doctrine called the investor control doctrine. This all has to be discretionary money.
And we'll get to that. We actually have a slide, guys and gals, on the downsides to private placement. One of them is the cash premiums. The other one is investor control. We'll talk about that more after we get through our case studies as well. So good questions though. Robert, you just followed up as well. Minimum level to make this feasible is really 5 million. We can go down to 2 million in some cases, but really we're looking at kind of a $5 million account size. So that's premiums or contributions or investment, however you want to think about it, on that front. So you can get Greg asked, where can you get the slides for today's presentation? I believe that this is being recorded too. I believe we're going to send out a PDF of these slides after the presentation is over. And then Brian, good to see you, buddy. Thanks for the question. Do any IRS related party self-dealing rules apply? Can Ppli hold LP interest if the insured is the GP? So short answer is yes, those rules apply, and no, you cannot self-deal, unfortunately. We like to say two things: if we could self-deal and if we could transfer in-kind assets in lieu of cash premium payments, we would have retired yesterday.
And not to get into the matrix, Brian, but if I'm a kid of the general partner that has no active involvement in the limited partnership, I could own that. So there is a way around it, but again, that's regarding the planning of the family group.
Yeah. So there's lots of nuance to this. We're happy to get into all these questions, all these planning considerations. There are some hard and fast lines and rules we have to follow, but there's also a lot of creative solutions around some of these questions that you guys may have as you think about clients that might benefit from this. So I think this slide speaks for itself. I don't want to belabor this anymore. And we have a number of slides still to get to. So again, thanks for the questions. We appreciate that. And we will keep, by the way, one thing on the inside of the estate deal, I know it seems like an anathema to own life insurance inside of your estate. Again, if we think about this as an investment account, not life insurance, it takes on a little different feel or flavor. So don't immediately discount the fact that you have a client with $50 million in an investment account inside their estate. They absolutely could own Ppli inside their estate. Yes, it creates a bigger estate tax problem down the road, but they're going to have a big estate tax problem anyway. We're just creating a bigger pot of money to pay estate taxes on down the road. Again, the most ideal are dynastic trusts and things like that, where we can skip all the tax, but don't immediately discount the inside estate ownership consideration.
So this is, again, we've kind of gone over the benefits of this. We put this slide in just when we're sending out the slide deck. Everybody, you can more so review it just in case you need a refresher on what an annuity is and life insurance from a tax perspective. I think the difference between the main one to highlight is just the non-MEC versus the MEC. And really simply, a non-MEC Ppli policy gives the client access to the cash value. So if we're talking about planning perspective, if we want to pull out income down the line from the life insurance policy, whether it's buy a house or, create annual or monthly withdrawals for retirement income, we're going to design the policy as a non-MEC. If we're going to know this is a legacy play, this is legacy capital, we're going to design it as a MEC because it's less expensive to do so. But that's kind of the takeaway from here. An annuity, again, we've already gone over the tax benefits of an annuity.
So this is more for you guys when you get this presentation, a cheat sheet as to, again, what are the tax benefits of the various types of accounts and how do they work? So this is fundamentally why PPLI and PPVA work. This is a PPLI specific slide. PPVA is pretty much the same thing. It's basically the known cost of life insurance designed properly is less than the known cost today at today's tax rates of the tax drag. It's really that simple. The policy charges, expenses, fees, everything inside of life insurance is less expensive than the cost of paying tax. Now, this is simple math. All right, this slide right here is also typically what you'll see on an illustration, right? You'll have a gross investment return up here of 8%. You'll have a really high tax bracket, and they'll just project it forward for the next 100 years or whatever it is, and hooray, everybody wins. We're going to show you how we approach the space. Again, a very custom modeled tax return assumption, all that fun stuff. But this is, again, a simple view as to why PPLI works. On this side, again, just to run through the chart, we have an 8% rate of return. You can see the tax drag here, the federal tax, the state income tax. On this side, we have no insurance charges, right? It's a brokerage account at Schwab or whatever it may be. So therefore, out of 8%, the client's going to net 4.7. Over here inside of PPLI, again, I do the exact same thing taxably or tax-free that I can do taxably. So I get the exact same rate of return over here. I pay no federal tax. I pay no state tax. But I do pay about 80 basis points in insurance costs. So of the 8%, I now keep 7.2. So I get a 250 basis point win, 2.5% every year by investing in the exact same asset classes. So this is a really simple slide. Again, this might be a conversation slide you might even have with a client. You can say, Mr. Client, you can net 4.7 or you can net 7.2. Which one feels better to you? And again, 100 times out of 100, they're going to say 7.2, right? There's more to the story than that, but this is, again, functionally why PPLI works.
And I think it's, important to note kind of this piece at the bottom, everybody. Like the math always works with PPLI and PPVA. It does. But this is kind of what you're used to seeing from our industry. Again, a static number or some math calculation where the numbers look fantastic. But I think, again, as advisors, we're all biased towards this anecdote at the bottom. So unless understood properly, data can be a more compelling liar than even the most gifted of thieves. And oftentimes you see that with private placement, life insurance, and annuities. And we feel it's gotten in the way, actually, of people understanding. It kind of can close us off to, this is ridiculous, too good to be true. I'm not even going to listen for the remainder of it.
Right.
The quotes from Will Page, he's a fantastic economist, the original chief economist for Spotify. His book is Tarzan Economics. Couldn't recommend it anymore. So anybody looking for something to do or a book to read, highly recommend it.
So we've got 3 case studies we're going to run through. We find that learning about PPLI is great, but actually seeing it in action kind of helps everything stick. So we hope you find these 3 case studies helpful to you as you kind of think through clients you might either work with or service or whatever. So we've got a multifamily office. We've got a family, a high income, high net worth family. We've got a single family office, a very complex application of PPLI. And then we've got a very simple one to end the case studies with. And then after these, by the way, we're going to go through some misconceptions. We're going to go through some drawbacks, like what are the problems with PPLI still? Why doesn't everybody do this is the typical question. And then also the last one's going to be drawdowns, misconceptions. Where does it break? Where does it break?
Yeah.
Because that also comes up too. It's like, hey, come on. Again, it's great, but tell me about the real problems.
Greg just asked, is there a common break-even point for using PPLI? The answer is yes, Greg. We'll get to that.
Yeah, we're getting ready to show you. Yeah. So I think he's got an advanced copy of the slides because it's like in 3 slides from now.
10 steps ahead.
That's right. Thanks for the question, Greg. We're about to get to it. So here's case study 1. Again, multifamily office brought us a client, and our objective is to maximize the return for the client. So a 48-year-old male is a business owner, got a liquid net worth of 25 million, a total net worth of around 50. Actually, I think that number's closer to 80, but it doesn't really matter. Again, from PPLI, we're really only concerned about the liquid net worth because we're trying to maximize the investment returns. He lives in New Jersey. He's obviously paying the top marginal tax bracket because his income is north of $1 million every year. And the investment advisor provided us both tax assumptions, city, state, all that fun stuff, but also the expected return across multiple asset classes. And so we blend all that together. The portfolio was expected return about 8.4%, again, over the long haul. This included some alt strategies, some equity positions, things like that. And we're actually going to show you guys what that looks like. So the goal from this particular client was to maximize the return of his $5 million of his investment portfolio.
So everybody, this is just, again, the data that we'll always request from the investment manager. They have all this. They know what's going on in regards to the planning in the portfolio. What WealthPoint, again, what Ryan mentioned at the start, we dove headfirst into this industry. None of our competitors do is able to analyze portfolios from a tax perspective, but also take current capital markets assumptions projected forward to be able to create an analysis that's bespoke and meaningful for the client. It's not just this random math calculation and, hey, you should invest in life insurance because it blocks taxes. So you can kind of see here, Mr. and Mrs. Client, their dates of birth is important from a life expectancy calculation perspective. Their state of residence, as Ben said, is New Jersey. But again, the sample portfolio provided by the investment manager, by the RIA. So how they would allocate in a taxable environment if they were just investing in a brokerage account. You can see the kind of the portfolio tax treatment as well. So the overall allocation, you can see my fixed income is 100% ordinary income. My muni bonds have no tax whatsoever. We would never recommend putting muni bonds inside a private placement life insurance or an annuity, because again, they're tax deferred and tax-free vehicles that mitigate that. So why not take more risk from a fixed income perspective and have more yield compounding tax-free? Equities, again, you see 20% ordinary income, 25% dividends at 20%, and then short-term capital gains with 80%, long-term capital gains, 25% turnover rate. Basically that we break everything out by asset class. We're kind of surgical when it comes to this stuff, again, just to be accurate and put our best foot forward, but also for the client. How do those asset classes perform from a tax perspective going forward? And then again, we can kind of dissect everything from our perspective, take all this data, this information, and make something, again, that's easy to understand from the advisor's perspective, but also for the client.
So we take all this data and we put it through our modeling software that we've built, and we come up with this slide. So what you're going to see here, there's a lot going on this page, but it's actually a little simpler than you might first think when you first look at it. So up here, again, we've got our tax assumptions up here. Again, federal and state on ordinary income, federal and state combined on long-term capital gains. Down here, we've got those sleeves of investments, right? There's their fixed income, there's your munis, your equities, your liquid alts, your illiquid alts. Again, exactly those investment allocations along with the investment balance, the assumed return from capital markets assumptions from the investment advisor. And then here's our tax treatment, again, where we blend the rate out, right? We're not just going to assume a static X, Y, Z, whatever that rate might be. We're actually going to build it in common for or specific for the client. So ultimately what that gives us over here is this assumed tax rate across this asset class. And then again, for this particular thing, we're gonna consider 100% of these allocations going into Ppla. So that's what this means over here. We can also do this if this was a $20 million portfolio. We could then again take a percentage of each sleeve to then dump into the Ppla account and ultimately equal 5 million. But this chart down here is again instructive for the client as part of how we have this conversation with clients as well. We say, look, your current allocation is this. And they go, yeah, I know, I've seen this for the last 2, 3, 4 years, whatever it is, equities, munis, or whatever. I say, look, is there any difference between this pie chart right here and this pie chart right there? And of course there isn't, right? And that's very helpful for them to see. Again, from a simplicity, if you confuse, you lose kind of thing. And that's even why you guys will see a lot of you are very astute. You're like, wait, you said you wouldn't put munis in a Ppla account. There it is over there. Yeah. But again, when we're talking to a client, we want it to be as apples to apples. When we compare the outperformance of Ppla to what they're currently doing, we want it to be, no, oh, by the way, I switched this out. No, this is exactly what you're already doing. No change whatsoever. By the way, once we make the change, we're going to flip these munis out to some corporates and we're going to pick up even additional outperformance inside your policy. But for now, we just want to show apples to apples. And again, as we say down here at the bottom, it's an asset location change, not an asset allocation change. So for our T&E friends on the call, it's a lot of the reason why you guys do planning in various jurisdictions, whether it's Nevada, Wyoming, South Dakota, whatever it is. And your clients are used to location changes for planning purposes. And again, this is no different than that. So ultimately from this slide, tax rates and capital market assumptions, we're able to calculate an income tax problem on this $5 million portion of their account. And so we isolated 5 million of, again, the 25 liquid. We're going to, on these capital markets assumptions, we're going to have growth of $60 million over the next 40 years. Again, the client's 48. So by his age, 88, this is lifetime capital, right? It's going to grow to an account balance of $60.8 million. And over those 40 years, this client's going to pay at current tax rates. It's assuming no increase in tax rates. He's going to pay over $16 million in income tax only. All right. This isn't including estate tax. This isn't including any of that. This is just income tax compounded over his 40 years of holding this account.
Yeah, so oftentimes everybody, it's the first time, in fact, 10 out of 10 times everybody, it's the first time that they've been shown this number. It's not exactly scientifically perfect.
Yeah.
But it's a really, really good estimate of what's going to happen if the rate of return, again, consistent with the capital markets assumptions provided by the investment manager, stays true and holds true. The other thing that we've kind of questioned them on is, do you realize that this is a voluntary tax that you're paying the IRS? They have a lien on that brokerage account, essentially. You have a partner in your investment account. Do you know you don't necessarily have to do or pay that with, again, private placement life insurance and variable annuities per se?
So just like the estate taxes, we talk with our clients, the estate tax is a voluntary tax. There are ways to plan around it, mitigate it. Now income tax is a voluntary tax. If we have the right account, we have the right vehicle, we can plan around income tax as well. So let's put all this together for this client. What's this mean? All right, so here it is. The gross rate weighted return across all those asset classes in the brokerage account, again, as we already told you, it's going to be 8.4%. We're doing the exact same thing in Ppli, so it's 8.4%. So there's no improvement to Ppli, right? Again, apples to apples. We're missing a slide there. That's all right. So the weighted return, this is after tax. This is going to roll off here in a second. We apologize. The weighted net rate of return after tax is going to be 6.7. We don't pay any tax here. So we're going to pay insurance costs and fees. So our net rate of return inside of the Ppli account is going to be 7.77. So we're going to pick up 107 basis points of alpha. We call it structural alpha, right? Because this alpha doesn't go away after the first year. So we're going to pick up 107 basis points of alpha after redeploying these assets inside of Ppli, again, on a permanent basis. So ultimately, what's that mean? The cost over the client's lifetime, they're going to pay $16 million in tax. They're going to pay $7.7 million in insurance costs and fees. This is not a free lunch, right? This is also where we tell the client, and by the way, we're going to tell them where all this money goes to, but this is also where we tell the client, look, this isn't too good to be true. You're actually paying for something, right? This isn't like some get out of jail free card. You're absolutely paying for the cost of this product. But that means we're going to save the client at least $8 million on the expense ledger. And what's that ultimately means? The projected balance at the end of 40 years goes from $60 million. We already saw that number on the brokerage side to $85 million on the Ppli side. That means we pick up $24 million of outperformance over a client's lifetime on a $5 million investment. Stated another way, that's a 40.3 improvement over the brokerage account, or a 4.9x return on the original investment. So on a $5 million investment, you're going to get a nearly a 5x return, an improvement just doing the exact same thing. And again, apologies for why this slide didn't show up right here, but this is just the tax rate right here. And again, blended tax rate is roughly a 24% blended tax rate. So anything else to add there?
No, I'll point that out.
All right.
Again, the ledgers, we won't spend too much time here, everybody. There's a couple of things that we're highlight, but Greg, to kind of bring back your question on, is there a common break-even point for using Ppli? The answer is yes, and it varies depending on underwriting of the client, age, the amount of money we're investing in the Ppli account. But you can see here two forms of break-even. We always highlight it in two different ways for the client. The yellow line you see is the cost break-even point. So as Ben said, the economics of the trade is I'm trading taxes for life insurance costs. So when is that amount that I'm paying in taxes more than the private placement life insurance policy? In this case, it was year 4. So essentially the life insurance cost breaks positive at year 4. So I'm going to pay less in insurance costs going forward than I will in taxes every year going forward. The gray line highlights or accentuates the break even in cash value. So I'm going to invest 5 million in Ppli. When is my account value or my cash on cash investment back again to square one? And in this case, it was year 6. We've seen break even points cash on cash as soon as year 1.
That's right.
With larger investments.
That's right. The blue line down here is, again, this 40-year time horizon. Again, these are lifetime accounts, right? So we pick a long time horizon. If they're under 60, we pick 40 years. If they're over 60, we pick 30. Just as, again, some sort of benchmark or marker by which we can measure, hey, again, what's the outperformance going to be? Is it worth doing all the work to get this thing done? So again, there's a lot of numbers on this slide. It's hard to see. Again, you guys will get copies of this after the presentation. We're doing a 4-pay, by the way, here. Again, that's 4 payments of $1.25 million. That's to avoid that MEC treatment that we talked about, which would make everything coming out taxable. So we get 4 premiums in of 1.25 each. That gives us our $5 million over 4 years. That's going to buy a death benefit, as you see there, of $17 million. And again, the key thing here is minimizing the death benefit. Again, it's hard to see right here, but this yellow line, the death benefit goes from 21.7 to 15.9. Again, that's a manual reduction that we go in and do on behalf of the client to make sure that we minimize the costs and the fees and expenses associated with the insurance policy. And then again, it happens again here at the end of year 7, a $15.9 million death benefit gets reduced further to 12.2. That's the lowest amount we can take it at that point and still maintain this tax-free status of the insurance account. Those reductions in death benefit aren't mandatory and they don't have to be done. So if there's a change in health, the client can actually keep a higher death benefit if that's valuable to them. But again, for most of our clients, they're going to reduce the death benefit on a proactive basis to make this account grow as fast and aggressively as possible. So again, as we just said, year 4, the cost taxes crossover. Again, that's when the cost of the PPLI contract is less than the cost of taxes. Year 6, there's the break even. Again, we're just blowing this up, so we know it's hard for you guys to see on the slide. So there's the account values on a projected basis. And then all the way out at year 40, there's our 85 million in account value in PPLI versus 60 million in brokerage. So Greg, hope that answered your question. And if you have further questions on this, feel free to drop them in the chat as well. So let's talk a little bit about expenses. And we've got 2 other case studies. So let's cruise through these. Yeah. We don't want to undersell this at all, but we spend a lot of time on expenses with the client. Again, we don't want it to be too good to be true. They are paying for the cost of the insurance. There's a lot of costs coming out. You saw for this client, 7.7 million. Where does that money go? Who gets paid and what are those things that are coming out of the contract? So all of these expenses, by the way, so when you see the total drag of 67 basis points at life expectancy or year 40 for this particular client, what's that inclusive of? Well, that's everything for the insurance contract, right? So for the PPLI account, that's everything. That's us, that's the carrier, that's the administrator. For our investment friends on the phone, your fees are the same. It's a wash, right? If you're managing money, brokerage or IRA, charge the same amount of money. If you charge, whatever, it's going to be the exact same. So we don't even include that in the analysis because it's going to be a wash for our investment friends. So the average cost for this particular client is less than 67, or it's right at 67 bips at life expectancy. That includes carrier fees and expenses. There's an M&E, mortality and expense fee that represents the profit of the insurance company. It also includes a broker, an insurance broker, AUM fee. Typically, there's a fee assessed to the carrier, to the contract to administer the policy, model out the loans, the withdrawals, the repayment of those loans and withdrawals, to coordinate with the investment professional and the performance of the policy, all that fun stuff. So there's a small trail fee in there for that. Then there's the monthly cost of insurance as well. So again, this is a life insurance contract. You are buying insurance. So the COI, the cost of insurance, is baked into this fee as well. And one key thing here is this based on the net amount at risk. I don't want to get too deep in the weeds on NAR. That just means there's a difference between the account value and the death benefit. There always is. Okay, as the account value grows, it will push up that death benefit automatically. The difference between your account value and the death benefit is the net amount at risk, and that's where the cost of insurance is assessed. So if I have $100 million in PPLI and $110 million death benefit, I'm only buying $10 million of insurance. And so again, that's also why PPLI works at older ages. We're not buying a lot of insurance. That's how we keep our costs low.
Yeah, next, these are fees going on the premiums paid into the policy, everybody. So as I deposit or invest my cash in the life insurance policy, I'm assessed 2 different types of fees from this perspective. So first is DAC assessments. They're federal tax, essentially, that the life insurance company pays for policies, and they pass a little bit through to the policy itself, again, on premiums going in. So it's not a federal tax that the client pays. It's actually what the insurance company pays, but they pass through a little fee per premium. The next is a state premium tax levied on the premium that comes out of the cash value that the policyholder is subject to pay. For that purposes, there are certain states that we can set these policies up via LLC or a trust that have more favorable state premium tax rates, to name a few: South Dakota, Alaska, Wyoming, Delaware. Then there's ongoing administration and structuring fees. So depending on the investment manager, they might have an administrator, an intermediary, to manage some of the legal aspects and compliance details with these policies. There's certain administration fees for the amount of money under management that they have. And then there's an insurance broker structuring fee. So usually a fee charged by a WealthPoint or a broker to cover our cost of analysis, our cost of doing business. There's underwriting heavily involved in these projects, and oftentimes they're complex sales involving estate planning and multiple planning aspects. So we're not just running one widget analysis, it's based on the entire balance sheet of the client, which takes up a lot of time. So there's a structuring fee to, again, put these policies in place.
So again, fully baked, we're looking, and for most clients, we're looking at somewhere between 60 and 80 basis points of fees for the lifetime of a client for most clients when we do this. And again, when compared to taxes, it's significantly less. So here's what those charges look like over the lifetime of a client. Again, this is that same client. There's the premiums going in. There's the premium taxes. I'm going to blow this up here so you guys can see that a little better. Here's the premiums going in. Here's the premium tax. In this particular case, we use South Dakota. There's that distribution charge we talked about. Policy load is charged by the carrier. It's a one-time fee to set up the policy at the carrier. But then there's the M&E. That's that mortality and expense charge we talked about. There's the COI charge. And then the total annual charges each and every year. So again, no free lunch here, but compared to paying taxes, much cheaper over the long run. And again, you guys can look at this in more detail when you get it after the call.
The next is just an expense summary as to why I'm going to pay these costs. So we start with showing the cost to the client face up. Here's what you're paying WealthPoint. Here's what you're paying the insurance carrier. Here's what the investment manager is going to get if they've included their fees as well in the presentation. But here's the why I'm paying that, right? So the left identifies what I'm currently going to pay essentially in taxes, everyone, capital gains, income taxes, and what my account value is growing to. So essentially over the 40 years, the client's going to pay that 14 million in taxes on the $5 million. Whereas if I do the exact same thing, I'm trading that tax expense for a life insurance expense. And over the 40 years, I'm trading 14 million in taxes for 6 million in life insurance costs. And then the last, we just show the Ppla advantage all the way through. So in 5-year increments, so the client kind of just see they're always going to be ahead.
Yep. So very
really
simple,
straightforward.
very straightforward. So ultimately what we do, we had $16 million in voluntary income taxes that we're going to be due on this $5 million portfolio on a projected basis. The solution is very simple. Relocate that same 5 million to a PPLI account. By saving this taxes and paying insurance charges instead, we end up with another $24 million of assets over a client's lifetime. So again, nearly a 5x result on a simple asset relocation for this client. On to the next case study, a little bit more complex, also a little bit bigger case. So we talked about earlier, someone asked a kind of a minimum size. That's that $5 million example is kind of that minimum size we want to look at. On the higher end, we're going to look at this particular case here. It's a family office. It's a $100 million relocation to PPLI across 5 different lives. And again, more complexity, right? So you guys can kind of see the facts here. But when we talk about complexity with an individual, you're talking about individual planning, estate planning, fund stuff like that. When we're talking about a family office, you've got real serious considerations. In this particular case, we had 44 entities. We had lots of moving parts, lots of different decision makers in the process. And it was like anything, the more money you're talking about, typically the more complex, but to be able to build the processes and modeling to be able to accommodate this kind of thing was really important.
Yeah, the education piece for the family office, everybody, was they have a lot of money here, 297 million. Actually, to highlight, essentially that's just a dead asset for them. They're a real estate family group and they're living off the income from that real estate portfolio. This is kind of just sitting out there in the ether, invested wisely that the single family office is doing, obviously, but it's just creating tax on the income tax returns again that flows through from the LP to the 44 different entities. So it was a really good project that we did to be able to identify, all right, how's that portfolio doing, and really took in what the family office was accounting for was gross return net of fees, but they weren't calculating what my net return was net of taxes. So it gave us a project that we integrated, essentially became an extension of the single family office to do a rigorous tax analysis for them, take a look into the portfolio and how it's performing over the last 5, 10, 15 years from a tax perspective, and then get their capital markets assumptions again going forward and start doing a projection of what we can actually mitigate in regards to placing a portion of that portfolio inside a life insurance policy or multiple life insurance policies in this case.
So because they didn't report on, net return after expenses, right? They just do gross returns and then after fees. And remember here we've got these different sleeves. They got large cap, mid cap, small, international, alts, income, munis. We needed to build out tax assumptions for them to actually figure out what they were getting after tax. So here, this is just their large cap sleeve. And what we did is we got actual returns for the last 5 years, inflows, outflows of this particular sleeve, ordinary income versus short-term, or inclusive of short-term, long-term dividends, all that fun stuff, unrealized gains and losses, ending value. You can see kind of all the data that's going into that. We're going to build a model for them to actually understand what were they actually paying in tax. Again, they hadn't done that calculation. So if you don't know what you're paying, I guess, ignorance is bliss, so to speak, but you also won't understand the value that Ppli can bring to this particular situation. So we built out this model. Again, this is just a large cap sleeve. We did it for each individual sleeve across the entire $300 million portfolio. And ultimately what we did was we calculated ordinary income per dollar invested, long-term capital gain per dollar invested, and then unrealized. What's being deferred? Half of these assets are owned inside of a trust. Obviously, deferring tax is great, but you're not going to get that step up upon death. And so there's going to be this future lien assessed on these values when G4 or G5 dies. We need to calculate that too, because assets inside Ppli will be transferred 100% tax-free. So again, a lot of math going on in here, a lot of complexity. But from that, and again, across each individual sleeve, you'll see up here across the top, we were able to project what their actual tax drag was going to be. And so you can see here the large cap, the portfolio weighting again across the entire portfolio, the forecasted return, and then the weighted return against the $300 million portfolio. Here's the tax allocation treatment. Here's, again, because the different owners of this investment sleeve, or these different investment sleeves, I should say, were in different states, different jurisdictions. We had to be a little bit more generic on the tax than we'd otherwise want to be. But it still gave us a good starting point from which to be able to have meaningful conversations. So we assumed long-term cap gains at 30, ordinary income at 45, very low turnover. Again, this means that most of the portfolio is not going to be taxed year in and year out.
Yeah. And so everybody knows, again, the single family office has a tax department, multiple employees. We went back and forth a lot on this just to get them right. What is the right numbers here? What can we be comfortable with from a conservative standpoint projected forward? Because a lot of this is model going forward. We all know what happens to models when they, have a certain time horizon or timeline. So eventually, again, 5 meetings or so, we came on, right, this feels right for the overall portfolio, again, projected forward from a tax perspective. So it took a little bit of time, but it's worth the time going in to actually do the analysis correctly.
So you'll see across the entire portfolio, we were able to work with the family office and determine about a 7.83 expected rate of return based on historical real rates of return, and about a 5.87 net rate of return. So they were losing about 200 basis points on average of their gain every year to tax. And so we're able to use that model now and dump it into our model that we just showed you guys on that $5 million example and actually come up with an income tax problem. So we've got 100 million of the 300 million. We've isolated that. Again, we've taken chunks of the sleeves, the most inefficient, the most high tax. And what are we going to do? We're going to look at earnings over 40 years. Going to earn $1 billion over 40 years on this $100 million portfolio. That's a good number. It's a good outcome. The family office is going to be happy with that. But there's actually a $267 million drag alongside that $1 billion in gain, and that's a real problem. Again, as Aidan said in the first example, that's a problem that's completely avoidable, completely voluntary now that we can relocate those assets to Ppli.
Yeah, and again, everybody, the first time that the single family office had seen that number,
that's right,
and it hurt.
That's right,
a lot.
And that's the point, though. We want that the problem has to be big enough for the client to solve it. If that tax problem isn't big enough, we would be the first to say you shouldn't relocate your assets to Ppli. It's not worth your time. It's not worth ours.
But wait, there's more.
It's the infomercial part of the presentation.
Yeah, it said like Dr. Evil with a thumb or a pinky finger at the side of the mouth. But there's dynasty trust, or dynasty trust, as Americans say. I say dynasty. Considerations here. So I don't know if we mentioned it at the start, but over half the assets were owned inside dynasty trusts, different dynasty trusts. What happens there? My investment portfolio doesn't get a step up in basis in a trust. It just, again, if I'm deferring gains, I'm just deferring, and essentially those gains are going to get paid. We don't exactly know when we're going to have to pay, but we know that we're going to pay them eventually. So there's a further tax analysis that we need to do, again, based on the data, again, that we receive from the family office. So we mine through sheets and sheets and sheets of Excel.
This is Aidan's favorite slide. There's just obnoxious levels of data here.
Intentionally showing off subtle flexes that aren't subtle at all. But it kind of got us to this, right? So we know what's included in the estate. It's a fantastic tool inside the estate but also it's a fantastic tool outside of the estate, right? So if we can get a dynasty trust and use life insurance inside it, essentially we've insulated our investment portfolio from that loss of step up in basis. Now it's a tax-free death benefit. It's not exactly a step up in basis, but it achieves the same thing. It gives me tax-free money when the patriarch or matriarch passes away, or if generation 5 passes away, whomever the measuring life or the insured is, we get to create that tool. So for any trust and estate attorney, CPA, it is a magnificent funding vehicle for that. And the numbers are incredible.
Yeah. So let's add it all together now. We've got unrealized long-term capital gain at death. Again, we're just benchmarking year 40. Again, death could occur sooner or later, whatever, but we had to pick some date to be able to measure. We've also got some questions, by the way, so we'll get to those after the end of this case study. So we've got about $320 million of unrealized long-term capital gains. Again, potential tax owed, again, just at a WAG, again, not being state specific for each of the members of the trust or each of the members of the family at 30%. So it's another $48 million in tax that's going to be due on this portfolio. So if we add that back to the income tax that's going to be paid, we've got over a $300 million tax problem for the family office. Again, on an asset they're not even using. Again, it's liquidity, it's great, but again, they're not living off of these assets. And so the ability to block all those taxes is going to create a very significant outperformance. So let's take a look at it all together, all at once, and we'll kind of walk through this, how this all works together. So again, this is just like that $5 million allocation. There's the tax drag that didn't show up on the last slide. Again, apologies for that. But again, same thing. The current allocation is going to be the exact same as Ppla. Again, we're not going to change any of the investment mandate. We're just going to keep doing exactly the same thing. So 783, here we pay 25% in tax. Here we have no tax drag, but here we do have, again, insurance drag. So that's the difference between those two. So 69 basis points roughly, if my quick math is right on that. So we're going to pick up nearly 1.3% a year in structural alpha for the family group. Cost over 40 years. The tax drag, again, we just saw that $267 million versus $100 million roughly in insurance costs. So again, we're $160 million in expense to the positive. Projected balance at the end of year 40. So if we just did this on income tax planning alone, we're picking up $500 million, $525 million. Again, a 5X return for the client just on blocking income taxes. But again, wait, there's more. There's the tax consideration in the trust. So now we're going to block another $48 million in taxes. So again, ultimately at the end of the day for this family office, by moving a third of their portfolio into a PPLI structure, we're able to pick up a 6X return, $600 million of improvement over just one generation, by the way. Again, we can do this over multiple generations, but just one generation of planning. So very powerful solution for this client. And the last one just shows here a little bit of a flow chart of kind of how we had to do that. We had to relocate some family capital to a new South Dakota LLC. We talked about jurisdictional planning. When we're putting $100 million to work, we're absolutely picking the cheapest state to buy that product in, of course. Got 5 insureds, so we got to buy the 5 insureds from the South Dakota LLC. Then the family office, again, is going to be the discretionary manager. They're going to manage the money just like they did outside PPLI. And then they're going to put the PPLI back into these 6 investment sleeves we already looked at. So again, there is a lot going on. It is very complex, but we try to make it as simple as possible for the client, for the family office, and for all the advisors who are part of the conversation. So that's the end of the case study for the family office. Let's get to a couple questions that came in.
So we have one. Sorry if this is a stupid question. There are no stupid questions. How do you unwind this either later in life or at death so that you don't lose your assets in the PPLI at death?
So I think if I'm understanding the question correctly, how do you unwind this either later at life or in death so you don't lose your assets? So your PPLI account is a life insurance product. And when you die, you functionally get your account value back plus some death benefit. So you don't lose your assets. And again, all that comes back in tax-free as a tax-free death benefit. So there's no loss of assets at death.
Yeah, I think that's a question. I would say follow up with us.
Yeah.
There's a few ways that question can go, and a lot of answers to be able to unwind the policy, keep positions in place. So yeah, we could get into another half an hour conversation just on that alone.
David asks, who specifies the custodian? What are the typical custodians for the assets?
Yep, the RIA or the investment management firm specifies the custodian. It's your current custodian. So ideally, that's the most easy way, whether it's Schwab, Fidelity, Ameritrade, Pershing. Whomever you use you can just set, it's like opening an SMA at your current custodian. It's the exact same. How does the family office relocate these assets into a new PPLI if they have to sell the assets and then put them back into the PPLI? Yeah, so that's a further tax analysis we did with the tax department of the family office. Because again, that affects the ROI, right? If I have to liquidate positions in year 1 or year 2 or 3, if we're structuring premiums over a couple of years, there's going to be a hit to that, right? There's a tax hit that I'm taking in year 1, 2, and 3 to then invest inside the tax-free structure. But essentially, they liquidate the cash. In this scenario, flowing out to the entities and 44, and then again, going into the flow chart here and repurchasing similar, if not the exact same positions within the new SMA inside the private placement life insurance policies.
Shannon asks, who are you insuring in your family office scenarios, and how are you handling the conversations around significant taxable gifts to IREV trusts? Good question. In this particular example, we insured G4, which happened to be roughly all in their 50s. G5 are late 20s, early 30s. We could have picked them, but we wanted to maintain their insurance capacity for maybe a round 2 of this for future dynastic trust planning.
That's like from an economic perspective, Shannon. Essentially, anybody with an insurable interest, that's the term, insurable interest, can be the insured on the policy. I don't necessarily need to be the insured to be the owner of the policy.
That's right.
Right. So,
and the conversations around taxable gifts, again, this particular example, the gifts had already been made. So there were no conversations around additional gifts. But that's just a part of what we do anyway. I mean, we work with really wealthy families on the estate planning side. We work with them on gifting and wealth transfer and all that fun stuff anyway. And so,
and it's a collaborative effort with the advisors, Shannon, right? So in this case, it was the internal trust and estate attorneys with CPAs and their tax department and the investment team as well. So we're integrating this with the current planning that the client already has in force. So we're meeting with their trust and estate attorneys, CPAs as well, because it has to be a good decision from a planning perspective, not just, again, a single individual.
And keep in mind, you don't have to move it outside in a dynastic trust or a SLAT or anything else like that. You can absolutely own it inside your estate, and you can move it later, right? I mean, it's just a regular gift if you want to move it later. Ed asks, if you need liquidity, can the trustee borrow? The answer is absolutely yes. We're going to talk about, that's actually one of the misconceptions, is money that goes into this PPLI account becomes untouchable. I can't go get it. It's forever. The answer is it's actually very accessible. And we're going to talk about how you can actually access your money here in a minute, because that's a big question for clients. One of the reasons they don't do it, I think, probably the number one reason they don't do it is they intellectually, emotionally, whatever, feel like it's gone. And we want to really work hard to dispel that myth. All right, so back to here. Last case study, really simple. And by the way, we've got 20 minutes left. We're at the end here. We have a few misconceptions, where it breaks, downsides, all that fun stuff. We're going to get to that and then wrap it up here. But last one's charitable legacy, really simple case study and fact pattern. You want to take this one?
Yeah, we were introduced again by the investment advisor. Everybody, we had built their platform, the separately managed account platform, to be able to manage the assets via annuities and life insurance. So that was already set up. But the client, the advisor had done really good bucket planning with the client. So the client was, of my portfolio, of my 65 million, I know that 10 million is going to go to charity eventually. So again, an annuity is an amazing tool to be able to use for charitable planning or charitable gifting, because essentially I get to open an account that gives me tax deferral, and I'm just creating more assets that I'm going to be able to pass on to the charity upon when I die, or before that, whenever they want to again gift that annuity itself. So the goal for the client was just maximizing the charitable bequest.
And I'll say that I think annuity for a lot of our friends on the call is probably not a dirty word necessarily, but probably not well regarded. Again,
I consistently get that.
I think you need to disassociate, kind of like PPLI is a different breed of life insurance. A PPVA, a private placement variable annuity, is a different breed of annuity. It's cheaper, it's more custom, it's more bespoke in terms of the investment choices. It doesn't have all that hairiness or whatever you want to call it, negativity that you might have on a traditional retail annuity.
Yeah. So again, the advisor and the client together, we're peeling off 10 million and it's going to go to charity. So I'm going to put it in an annuity. So again, everything comes from the advisor. Again, tax analysis in regards to the client's current state of residence, what the portfolio is doing, everything's bespoke. And the rate of return that he gave us was 8%. He said that was conservative based on the age of the client at 43, projected forward, trying to do a lot better than that. But again, maintaining, again, a conservative aspect to this analysis. But again, what can I do inside an annuity versus a brokerage account? So if I take 10 million, the good thing about an annuity is I can constantly add to it if I want to as well. So again, 10 million is going in day one, and it's currently getting deferral again projected forward. My account value over, I think it was 40 years.
This is 50 year time horizon.
Yeah. So to age 93, my account value is going to grow to 392 million inside the annuity versus 225 inside a brokerage account. So why pay taxes along the way if you don't have to?
That's right.
If you've done really good bucket planning, again, financial planning with a goals-based approach, you know they're going to do that request. Why not put it in a vehicle where you can defer tax? And that's the alpha generated was 1.16% or 116 basis points every year just by putting it in an annuity.
So you can see this is year by year. We significantly truncated the number of years we showed you just because it got obnoxious. We showed you the first 10 years over here and then summarized by 10-year increments, but there's $10 million goes in, the account value grows. What we neglected to show you here, and again, we do this on all presentations. Again, we didn't show you the annuity cost. I believe this was like 45 bips all in. At life expectancy, we're at 38 bips. So we're actually even lighter than that. And again, that's because as asset values grow, you saw those tiered costs, they actually go down the more assets you have inside the account. So again, all in over the client's lifetime, 38. And again, cash surrender value, there are no surrender charges on this. So these two equal each other, right? There's never a time in which you're worse off inside the Ppva. You can see the tax drag over here on the account otherwise.
And I think, again, that was a good point that Ben mentioned. Again, it's 38 basis points to block tax, again, over a 50-year time horizon I'm gifting to charity. Again, I think a lot of the misconceptions that people have are annuities are expensive, and traditional annuities are expensive. So instead of 2% a year that you would pay in a traditional annuity, you're paying 38 basis points, again, versus taxes. The economics just win all the time for annuity, depending on the goals of the client.
Yeah. So here, again, we get to avoid $52 million in tax for a very, very low cost. I think the other way to think about an annuity too, this is for a charitable deal, right? You're going to give 10 million bucks, whatever it grows to, give to an alma mater, a church, a hospital, whatever it may be. But another way to think about annuities too are on a proactive basis. If your clients have income portfolios, right, that are throwing off significant income, but they don't need it every year, but they need liquidity, they need access to it from time to time. You can move an entire liquid strategy, bonds, money market, whatever that may be. You can move that into a private placement variable annuity, and now you have the ability to control the tax timing and impact of that to the client's tax return. Again, when the client needs money, you pull it out. You haven't changed the tax characteristic at all. You can go get all the money in this Ppva at any time you want. All the gains come out as ordinary income, again, which is a negative. But again, if you're moving income taxed assets anyway, it's just the same. So voiding $52 million, and we already showed you guys this, we're going to increase a $10 million gift. Again, it's ridiculous. Again, the power of blocking tax over a client's lifetime. That's a 16x return just simply by blocking tax for a client's lifetime. So again, the Ppva story is a simple story. We think it's wildly underutilized in planning, not only at the uber high net worth level, the family office level, things like that, but even for your clients, again, that just have simple investment portfolios with income taxable assets that we can shift into here. So let's get down to now. We've told you all the great stuff about Ppli, Ppva. I mean, it's all unicorns and pixie dust and roses. And but there are some downsides. There are some things where you guys need to be aware of. So let's talk about those here at the end before we wrap up. So let's talk about some of the downsides. It's come up a couple of times through the questions. One of the downsides is cash premiums. We cannot take existing positions and transfer them into the policy in lieu of or in kind of premium. We like to say, again, we would be retired yesterday if we could have done that. There's just no way around recognizing any kind of gain that your clients may or may not have. That said, don't let this get in the way of like, oh, my client's fully invested, we have lots of gains. Let this get in the way of this might be a good fit for your client. We absolutely can model out any type of increase in tax that your client might incur by liquidating the cash. And in almost all cases, again, if we do the right modeling analysis, we can typically minimize the increase in additional tax by going to cash. Typically, your clients are rebalancing their tax loss harvesting, they're reallocating to various opportunistic funds throughout the year. Your clients' brokerage accounts often create cash, year in and year out. We can use that money to fund the Ppli account over time.
Yeah. I'd say please reach out to us.
That's
about
right.
that, everybody. The modeling again is incredible. It's not mentioned in this presentation, but please follow up with us individually if you want to learn again more about how we do that analysis.
That's right.
A case again that we have it. Next point is investor control. We mentioned it already. It was one of our questions, right? One of the downsides to this is the client cannot direct individual recommendations on the underlying portfolio. For example, I can't say I want to buy Tesla, sell Apple, or buy Apple, sell Tesla. What they can do, though, is they can be involved in developing the investment policy statement. So they can be involved heavily in putting the guardrails in the bowling alley, per se, of developing what their strategy wants to be, you know, from a time horizon perspective. So I want long only equities. I want a long short portfolio. I want commercial real estate. I want these types of limited partnership investments. They can have kind of influence in that perspective. They just can't, again, communicate with the advisor as regards to individual stock picks or individual limited partnership interests, or be a general partner in the operating.
Yeah, and that IPS, the investor policy statement, can be amended. So again, you can start it with a very generic investor policy statement. You can then amend it and go very specific as assets get deployed. Again, you can say, I want private equity and biotech only in the Northeast corridor, for example, if you wanted to be that specific. So lots of flexibility, lots of ways to, again, create the guardrails without doing specific investments. Another downside is added complexity. Again, we're adding life insurance, which adds all number of emotional heartburn to a lot of our clients. We view this as a conversation and education, not a sale. Again, we're working with the advisory team, the T&E attorney, the CPA, the investment advisor on nearly every case. But for the client, it still is another layer. And so that's a downside to adding Ppli to the transactions.
Yeah. And then again, the question I think that Greg had earlier, there's a break even, right? Yeah. So, but we kind of want to take a long-term approach, a full balance sheet approach over the next number of years, so the client can understand. But again, we'll always highlight those break evens. So if the client wants out in 3 years, don't do private placement life insurance or an annuity.
Yeah, right.
Pretty straightforward.
Yeah.
So, but we'll calculate that again and show it.
But if the client intends to keep his money working for him for his lifetime, it will almost in every scenario work out to their benefit. So where does it break? We found it breaks in 3 scenarios. The first one I mentioned this kind of at the outset is when Ppli is designed for death benefit, not investment returns, it can break. Again, that's where we don't minimize the death benefit, where we buy as much death benefit as possible. So in this example, the first example, we saw a $5 million contribution buying $17 million of death benefit. I could probably buy $100 million, maybe $150 million of death benefit on that client in Ppli, but then I'd have to put another 5 million in the next year, another 5, and so on and so forth. And so again, that puts a lot of strain on the earnings inside the account. And again, if you don't manage these policies post-issue, it can create real problems for the policy long-term. Again, designed properly, managed properly, Ppli doesn't break, but that could be a consideration. If you maybe had a bad experience in the past with it, maybe a T&E attorney on the call has done that, that might be one of the reasons why. Related to that is severe underperformance of the alternative portfolio. So again, if you're alts heavy, let's say you went 70% alts and all your alts went to zero. Well, now you've got a bunch of cash value that was supposed to be there that's now not there. Again, that net amount at risk, the difference between your cash value and death benefit is higher. You pay more expenses and fees. Again, that can be a significant drag. And ultimately it might break the portfolio or the policy if you had, again, I don't know if it's a black swan, but certainly if your alt portfolio went belly up, all of it, it could be a real problem.
And then the last point, everybody, is again, that investor control doctrine that we mentioned on the previous slide. There's only been one case in history to call the Weber case for anybody that has no time and wants to look it up, or Cure for Insomnia. But essentially there was 300 emails exchanged between the client and the advisor, again, recommending different stock picks and trades. You cannot do that at all. We don't want the IRS on our tails. They collapsed the policy. Essentially, everything was taxed as ordinary income. So again, we need to be very, very careful in regards to how we're communicating with our clients on the underlying cash account, essentially, that underlies the life insurance or the annuity chassis.
Yep. So we've got just a couple more slides. We know we've taken a lot of your time. We really appreciate it. We hope you found this valuable. We're going to run through common misconceptions real quick. And then at the end, we've got a QR code and a link to a data form that you guys can fill out. You say, hey, I got a guy. Let me talk to you more about it. Just a few things we need from you to be able to kind of run through a potential scenario for you. So some common misconceptions. These are all things we've actually had advisors say to us or clients, and we just want to debunk them right out of the gate because they're just misconceptions, candidly. So the first one is it's an irrevocable decision. The reality is it's not. There's no surrender charges. You can walk at any time. Client puts 5 million in year one and hates it. They want to start paying taxes again. Congratulations. You may have the dumbest client in the world, but you can absolutely walk away from the contract and get all your money back.
Next one, the money in PPLI should be considered last resort money from an income perspective. Again, we got it a lot from advisors, just not true. You're recharacterizing income as tax-free income via a loan from the life insurance policy. So it's an incredible actual planning tool for income needs, or when you're doing your income planning for your clients.
Clients with fully invested accounts won't work. And again, we already talked about this briefly, but the reality is that's not a reason not to do it. We absolutely can talk about the cost of paying taxes now versus the cost of paying in the future. We can do that analysis. By the way, if it doesn't work, we'll let you know. Again, we're not here to waste our time or yours on a scenario that just doesn't benefit the client.
It's hard to use your money in the PPLI account. Just not true. Absolutely not true. T2 money is T2 money. It's the exact same to be able to make. It's actually easier to use your money inside the life insurance because I don't need to worry about tax ramifications of liquidating positions. I can move this money very nimbly between manager or strategy or whatever you want to do. And again, there's other ways to get money out of your account. You can create lines of credit, securities based, or you can collaterally assign a policy to banks. They love life insurance policies because of the underlying value that they can lend against. So yeah, and it's really cost effective to do so.
Last one is insurance is really expensive at older ages. The reality is that's true, but because we minimize that net amount of risk, right? The difference between your account value and the death benefit, when the client gets really old, that cost is minimized. So that's really not a problem for PPLI. For new policies, let's say you've got a 72-year-old with a lot of liquidity and they go, I'd really like this deal, but am I too old? Yeah, probably. I mean, it might work, but it might not. In that case, as a 72-year-old, 75-year-old, we might insure the kids. All right. And so again, the owner and insured don't have to be the same. And so there's ways around this expensive, misconception.
Kind of going back to Shannon's question earlier.
That's right. So who's the ideal client? Let's kind of put a finer point on this, just so you guys know as you're thinking about it. All right, who should really consider this for implementation? So families with liquid net worth north of 20 million. We typically recommend, regardless of net worth, somewhere between 25 and 50% allocation to PPLI, PPVA.
Yeah, all ages. Again, as Ben said already, under 70, we typically insure G1. Over 70, we insure G2. And again, as we've mentioned multiple times, the owner and insured does not have to be the same person, be different. The obvious ideal client is liquidity events, money in motion, right? So sale of businesses, it's cash on cash. Should I, invest in a portfolio in a brokerage account, or should I invest in a PPLI policy with tax-free growth or tax deferral in a private placement variable annuity?
So hopefully at this point, we've achieved all of our learning objectives, and you guys are going to be able to get your CE credit. We've got a couple of questions. We're going to get to that right after this. So hopefully you understand the basics of PPLI and PPVA and how they work, the types of investments, the tax treatments of the strategies, the misconceptions, and the evolution of SMAs against IDFs, the 3 client strategies that worked from a goals-based planning approach.
And then hopefully, again, I'll leave on a little provocative anecdote that I like to do from J.K. Galbraith, the Canadian economist, not American economist. He's fantastic. Sometimes the Americans claim him as their own, but he's not. And he said, again, paraphrase, I'm probably doing him about a disservice, but something along the lines of, with human beings, when forced to choose between changing their minds and seeking or clarifying their own opinions, or proof of their own opinion, humans usually get working on the proof. So the idea is hopefully today we've changed your mind. And if not, please reach out to us to learn more. We've got tons of material. This is, again, tip of the iceberg of what we've done from an analysis perspective. We want to get you guys comfortable so you actually start leveraging it as planning, leveraging both as planning vehicles. We think, again, just as educated advisors, there's no reason why ultra net worth families shouldn't all own one, or if not both, of the annuity or private placement life insurance.
So for all of our friends over, what should we say, 50 on the call, what you do is you take your phone, and you point. Yeah, sorry, picking on all of our friends. But again, QR code, point your camera at that. It'll take you to our online data form. Again, that's just for us to start the conversation. You give us a little bit of information about the prospect or your client, and we're happy to, again, start the conversation about modeling out various scenarios and see if it even makes sense for you to bring it up with the client at all. Again, we view this as a conversation and an education. not a sale. We're not selling your client jack squat, candidly. Insurance is often done that way too much. And our job is to come alongside you and help you and your client achieve your outcomes for them. So a couple of questions that have come in. Review the risk shifting, the shifting of risk between the insurance company and the client. Actually, I think that's why PPLI works so well, is if there's any shifting of risk, it's the client shifts the risk to the insurance company for that net amount of risk, right? The insurance benefit, but the risks stay the same, right? I mean, if I'm managing this portfolio taxably, the risk is exactly the same if I manage it taxably or tax-free. So we're not adding risk to the client portfolio by shifting assets or moving money into the PPLI account.
Yeah, and it's different to traditional. Some retail policies, again, are subject to the general creditors of the life insurance company. These types of policies are different. Everybody are held in a separate account of the life insurance company. So again, it segregates the risk that if my life insurance company goes under, my account value is still protected. So again, it's a belt and braces approach to, again, risk shifting and risk management.
That's right. If that didn't answer your question, again, feel free to reach out to us. I think our contact information was on here. Greg, with another question, does the client have the option to pay the insurance cost outside of the PPLI, or does the insurance cost have to come from inside the PPLI funds? Never had this question asked. It's just automatically deducted from the account. And actually you want to do that because ultimately what you're able to do is, as you get earnings on that account, you're able to pay for the insurance costs with those pre-tax dollars. And it's seamless. And it's, again, the carrier just deducts those charges from that PPLI account every month. So the client doesn't get a bill. They don't see it. It's all disclosed up front. So it's not like there's some sort of, shady business going on, but the ability to pay for expenses pre-tax is actually a really nice thing. So we find that to be a benefit.
The investment management fees could be structured either way, Greg. So they can be deducted from the account balance inside the life insurance or annuity, or the investment manager could charge outside the account itself. So different ways to do it from the investment perspective, but the life insurance just deducted.
Yeah.
I think we're there.
So if there are no further questions, we've got 2 more minutes, but we're grateful for everyone's time. Thanks for taking an hour and a half of your day to learn about private placement life insurance. And hopefully, again, it's been beneficial. Hopefully each of you thought of somebody that could benefit from this. It's easy to put it on the back burner and say, I'll get to it later, but we encourage you, hit this QR code, hit the form. Even if you just get us your name and email, we'll follow up with you and have the conversation about how we can be a help to you guys and your clients. All right.
Yeah. And super appreciative for anybody who asked questions. That's
helpful. Right. Yeah. Really appreciate it.
It's interesting. It's kind of like podcast style that
we're used to seeing people on the screen. So one, it's nice not to have the distraction, and then it's nice to have the interruption, be able to kind of gather our thoughts. So
we have to imagine you all in your sweatpants at home listening. We didn't get to see you all, but
so Lucas, Kristen, thanks again. Thanks for being here. P-Wags, thanks, buddy. And if there's nothing else, we'll say thanks. We'll stop sharing. And you guys enjoy the rest of your day.